Hi guys, welcome back to Finpact. Today we're taking a look at two dividend stocks that are giving us big dividend yields of around 9%. Right now we're in a period of massive volatility both in the crypto markets and in the stock markets. So the best way to earn passive income during this time to hedge against the risk that we're seeing with capital price depreciation in our stock portfolios and our crypto portfolios is through dividend stocks. Also, I strongly advocate building up your dividend portfolio so that later on in life, you build a large pot which is filled with dividend stocks that yield you passive income that can pay off your expenses in the future. If you think 5 to 10 years from now and you build a large enough pot, that could pay off your bills, that could pay for your dinners, and you wouldn't even really need to work. But the key is to start now. It's never too late to start dividend investing. And if you have age on your side, then you have many years to start building up that portfolio. And then when you see bear market times like this, where there is so much volatility, stock portfolios are down more than 50%, crypto portfolios are down more than that, probably more like 80 to 90% for some of us. But the point I'm trying to say is that if you have dividend stocks, your stock price may fall, but those dividends will still have to yield the 9 or whatever percentage dividend yield that they have to pay out to shareholders. And that's a great way of hedging your dividend portfolio. For example, if you see your portfolio fall down 10%, so all the prices fall around 10%, then you are still yielding maybe 8 to 9% dividend yield, which you can reinvest back in. And that sort of acts as a buffer to the downward swing in price, because the dividends will be reinvested back in and you don't lose a huge value of your portfolio. Another thing is that dividend yield can help combat inflation. As you know, inflation erodes the purchasing power value of your money. So perhaps $10,000 now will be worth a lot less in the future because the overall cost of goods and services in the markets have increased. Dividend yields can help your portfolios grow if you choose to reinvest the dividends back into your portfolio. And right now, inflation is sky high. The US Federal Reserve have been increasing interest rates, and you can take a look on this chart how so many countries have inflation rates that are higher than 10%. That includes the UK, which is at 11.1%. We have the US sitting at a lower rate. As of October 2022, it was 7.7%. But overall, we are in a global state of high inflation, which is why dividend stocks can help shield you from the higher inflation going forward. Also, guys, if we take a look at UBS's chief economist, Aaron Captain, he said that we haven't bottomed yet, and he predicts that the S&P 500 will collapse a further 15% or so more to 3,200 by the second quarter of next year. He does believe this belief on the increased risk of a deep global recession, and this, of course, has been made worse by the Federal Reserve's interest rate hike program. He actually wrote that weak growth and earnings drag the market lower before a fall in interest rates help it bottom. For the US, we now expect near zero growth in both 2023 and 2024, and a recession to start in 2023. Now, during times like this is why investors start looking towards dividend stocks, because dividend stocks act as that hedge against risk in the volatility of prices that we see in our portfolios. So the first dividend stock that we're going to take a look at is ARCC, and its ticker is ARCC. Currently, the price is sitting at $19.63, and the dividend yield is a whopping 9.19%, which is substantially higher than the sector average of 2.038%. ARCC Corporation is a business development company known as a BDC. BDCs actually sit at a mid to low end niche in the financial world. They essentially make capital available for companies that don't necessarily qualify for loans from traditional banking systems. One thing I must say is that generally speaking, BDCs do charge higher interest rates. This is usually for the risk that they take in lending to more riskier companies. So ARCC actually focuses on small to mid-market enterprises that are seeking new capital, different new credit facilities, and also financial instruments. So as of this past September 30th, ARCC's portfolio consists of investments in around 458 companies with backing from 224 private equity sponsors. The portfolio has a fair value of around $21.3 billion. And as you can see, it is highly diversified, not just on sector, but also asset class, industry composition, and issuer concentration. You can see that the largest part of the portfolio consists of first lien senior secured loans at 44.6% of the total portfolio. Second, they have second lien senior secured loans at 17.8% of the total portfolio. They also have a large concentration of software and services companies sitting at 22.5% of the portfolio. The next is healthcare services sitting at 10.1% of their portfolio. ARCC has also mainly invested in companies that are based in the West at 34.5%, the Midwest at 25%, and the Southeast regions of the US. Now, the ARCC Capital shares have actually outperformed the broader markets this year thanks to strong gains in earnings and revenues. In fact, the company declared a net investment income of $288 million in Q3 of 2022 compared to $184 million in the year-ago quarter. On a per-share basis, this comes to 57 cents in the current quarter versus 40 cents in the previous quarter. And this has been up more than 6% year over year. So turning to the dividend, ARCC declared a payment of 48 cents per common share on October 25th, and the dividend is payable on December 29th for the fourth quarter. They're also going to be paying a special dividend of 3 cents, and this was declared back in February. So just taking the regular payment, ARCC's dividend annualizes to $1.92, which gives us a yield of just under 10%. And what is also very reassuring is that the analyst rating consensus is a strong buy, based on 9 buy ratings and 1 a hold. The analyst stock price prediction is $21.06, which is 7.42% upside from where we're at. We also have 5-star analyst Devin Ryan from JMP Securities. He gives it a buy rating with a $22 price target, which is a 13.46% upside from where we're at. And he wrote that, given elevated concerns around credit, we are optimistic that ARCC is well positioned to outperform given its track record of superior credit underwriting, an experienced and long-tenured management team, a best-in-class origination platform, and the benefit of a multi-cycle tested business model. In short, we continue to view ARCC Capital as one of the best positioned BDCs to outperform in a more challenging macro environment. Moving on to the second dividend stock, and that is Medical Properties, and its ticker is MPW. Medical Properties is a real estate investment trust, so a REIT. Many of you guys know that REITs are known for notoriously paying high dividends. So Medical Properties Trust is a REIT focused on the healthcare sector. The company manages 434 properties in 10 different countries and with over 44,000 licensed medical beds. The company's assets are worth approximately $21.1 billion. And it's also the world's second largest non-government owner of hospital properties. Although to be fair, in the last few months, Medical Properties Trust has actually sold off around 15 of their properties. This was done so that they could reduce debt and improve liquidity by approximately $1 billion. Taking a look at their Q3 2022 results, the top line came in at $352.3 million. Now, this was down 9.8% year over year, but it is still within the company's historic range for quarterly revenues. And it brought the 9 months total to $1.16 billion. And this was up 2.5% from the first 9 months of 2021. So Medical Properties Trust did do better on the earnings front. Its net income per share came to around $221.79 million, which is around 37 cents per share. And this is substantially higher than the 29 cents per share from the prior year quarter. As you can see on tip ranks on the dividend section of Medical Properties Trust, that they declared a common share dividend of 29 cents, and this was last paid out in October. The dividend yield is 9.3%, which again is substantially higher than the sector average of 2.038%. And if we look at the current price, it's sitting at $12.68. The analyst rating consensus is a moderate buy based on 10 ratings, 7 a buy and 3 a hold. The analyst stock price prediction for MPW stock is $17.44, which is a 37.54% upside from where we're at, based on 10 Wall Street analysts giving stock price targets for the next 12 months. Also, if we take a look at 5-star analyst Steve Annika from Stifel Nicolaus, he gives it a price target of $17, a buy rating, which is a 35.67% upside of a price target from where we're at. And he said that we rate MPW as a buy, given the very attractive valuations on what appears to be a stable earnings base. And we saw that in the quarterly results. He then said that the stock has among the highest short interest in REIT land, based on the belief that the operating pressure will hurt the ability of tenants to pay rent. At the present time, we aren't seeing a large amount of that stress. Like many other segments of healthcare, MPW's tenants are in the recovery phase and operating results aren't yet stabilized or normalized. But overall, the EBITDA to rent remains strong. So guys, those are the 2 dividend stocks that analysts recommend that will give you a high dividend yield. What do you guys think of these 2 stocks? Do you guys hold them in your portfolio? Leave your thoughts in the comments below. And guys, remember, this is not financial advice. Make sure you do your own research before you invest in anything. And also, if you enjoyed this video, don't forget to hit that like button and that subscribe button and that bell notification so that you get informed on when I release a video, as a lot of the information is time sensitive. Thank you guys for watching, and I will see you in the next video. Bye!